So in this situation, Bevel Industries is considering whether or not to automate its production. So this is a very common business decision that people have to make. Are you going to continue to do things manually, or are you going to try to increase your production by automating it? And of course, what the companies have to grapple with really is to see, well, I'm making this investment, here in this case of $900,000, is it worth it? Is it going to be of benefit to me? So in this example here, all this information, of course, is taken from the table in the book. So it's showing you what the additional cash inflow is going to be generated by purchasing the equipment, because of course you can do things faster and it's going to generate more income. And of course, reduce some of your manual labor. So the net cash inflow is varying each year. So you have to do the calculation for each year. So again, the interest rate here is 14%. So it's 14% for each year, but the factor is different because you're going for year 1, n equals 1, year 2, n equals 2, and so on. So if it was even cash the whole 6-year period, you wouldn't have to do 6 calculations, but because we have different amounts of cash flow, you have to do 6 separate calculations. So just keep that in mind. If the cash flow is constant, the exact same amount every year, you just do the one calculation. So all we're doing here is we're just multiplying the factor, so with interest equal to 1% and the number of years equal to 1, you come up with the factor. So the reason why you have a present value for year 1, in this case you're assuming that the cash flow is not going to come in till the end of the year, so you want to present value that back. So when you add up the present value, so in today's dollars, what are these cash flows over the 6-year period going to generate? So that's what present value is really doing. It's taking future payments and expressing it in today's dollars, and it's assuming if you had that money today, it was going to grow at an interest rate, quite high rate of 14%. So the total cash in present value generated from this investment is $880,065. It's going to cost $900,000 to buy that equipment. So you have a negative net present value. So again, this is not something the company should pursue because it is a negative rate of return. So that concludes problem or requirement 1 of 12-29. So now we'll look at requirement 2. So requirement 2 is taking the original option and expanding on it. So it's saying that if they could refurbish the equipment at the end of the 6 years for $100,000, then it would provide additional cash flow. So looking at the next scenario, so what we're doing here is we're saying, well, at the end of the 6th year, if you spend $100,000 refurbishing the equipment, the first thing you want to do is put that in today's dollars. So in today's dollars, it's $45,600 because the present value, an interest rate of 14, and n equals 6. So as a result of that, you can generate $75,000 in the 7th year, but in today's dollars, present value that back, it equals 30. And there's going to be, you're told, a residual value. In other words, you can sell it at the end of the 7th year for $50,000. But what is that worth now in today's dollars? Well, it's worth $20,000. So the additional revenue generated from spending the extra money on the refurbishment is $4,400. So it's your negative 45, and your 50. So it's a plus 4,400. But don't forget, you still have to look at the negative net present value that you calculated in the first requirement. So it wasn't sufficient to generate a positive net present value, so it's still negative. So even though the refurbishment does generate additional cash flow plus a residual value, it's not enough to overcome the negative net present value that's incurred in years 1 to 6. So in that case, you would not be advising the company to go ahead and to do that refurbishment. So that concludes problem 12-29.